No worries. We're a true expert and we're putting in the work just like you're doing today to remain there or get there. And we build a level of confidence. Somebody check my spelling because I don't get to help with that one. Okay.
Be confident. You got it.
Yeah, good. Then we end up with what we're going for today and kind of the point to this title slide, and that's an advantage. We're gonna an advantage to the 10th degree, right? And this becomes important in any market, but I would argue more important in a market like the one we're in.
Yeah.
Right. So the market that we're in is not good or bad. It's just challenging in different ways. By the way, the market that we were in with 20 offers on every house was not good or bad. It was just challenging in different ways. Right. But what happens to the consumer in a market like the one we're in, which would be considered challenging in key ways, and there's a lot of there's a lot of uncertainty in the real estate news and what's happening with rates, or right, we're dealing with lawsuits from an industry perspective. All these things are kind of like dark clouds, if you will, to the consumer, unless they have an expert to guide them otherwise, right? So what happens to the consumer in times like that is they really start looking for an expert. Whereas in certain other markets, when everything seems easy or positive, sometimes the consumer starts to think that any old realtor will do.
Yeah.
They're all the same. Now, we know that's not true, but the consumer doesn't necessarily, right? So although we get an advantage in any market, if we become the local economist of choice and we have confidence around delivering that, we get a bigger advantage in a market where the consumer's like, where's the expert? Because I'm confused, right? There's a lot of news out there and I don't know what it means for me, for example. Does that make sense? So as we think through this framework for looking at this information, I hope that it will be even more valuable than just the information itself. Thoughts or questions on that? No? Good? Ready? Okay, here we go. So I want to start with, oh, maybe,
Oh, hold on. Let me just click on it and then it should work. Okay, give it a try.
Perfect. I want to start with some economic information. We'll look at some industry information, but the reason I want to start with economic information is this is some of the same information. It is the same information that the government looks at in order to set their economic policy. And is it fair to say that the government's economic policy impacts our industry?
Yes. Oh, yeah.
We've seen that dramatically in the last number of months. So let's look at unemployment, because that's key that the government looks at to see how's the economy doing and how might that impact our policy. And you can see that we're at 3.7 at the end of 2023, right? And how 3.7 relates going all the way back to 1990. Well, it's historically low. Up in the left-hand corner, right, the government's goal is that unemployment is 6% or less, right? Matter of fact, they consider full employment 4%, and we're under that. We've been under that for quite some time. For the most part, we had a little blip on the radar. I don't know, something weird happened back in 2020. You guys remember what it was? Right? Like we literally shut down the economy, so unemployment spiked briefly. You can see how quickly it came back down when we reopened, right? So, but we can see that employment has been strong for quite some time, little blip on the radar, short term. And what that means, if I was to summarize this slide to a consumer, for example, I would say that 3.7% employment means that anyone who wants a job has a job, right? There's plenty of people that don't want a job, and that's a whole other conversation. But if Corvallis and Albany, get that right? Albany. Is there an Albany somewhere? Did I just make that up? Here. Albany. And surrounding area, if it's anything like a lot of the places I've visited in Spokane, do you still see like a lot of help wanted signs out there? Do you still see local businesses kind of apologizing for being short-staffed on occasion? Yeah, so there's still more job openings than there are people to fill them because everybody who wants a job has a job, right? And we could talk about some of the pressure that this puts in the marketplace from a competition standpoint, average wage going up, et cetera. But but this is an underlying metric that the government says, wow, that is one element that demonstrates a pretty strong underlying economy. Okay. This is what the numbers look like on a monthly basis. So again, this is annual, this is monthly, and you can see again, blip on the radar, how quickly we came back down to everybody having a job. And that's one metric that they look at for the strength of the economy. Here's another one, GDP, gross domestic product. The way to think about GDP is it's the measure of the overall growth of the overall economy, right? So you can think of it that way. And you can see again, we had a pretty dramatic swing back in 2020 when we literally closed the economy. So we would expect that it would be down, right? And it was down dramatically for a short period of time, but then it was up dramatically, right? The government helped that with trillions of dollars getting pushed into the marketplace, right? And then you can see where we've been since. Now, the goal for the government is about 2% growth. That's what they're comfortable with. Anything more than 2%, oh, I don't know, 33.8% as an example, then we get concerned about another metric we track closely. So if the economy is growing too fast, what do we get concerned about? Inflation, right? So they want it at 2%. That's a manageable amount of growth. That would be a strong economy. 3% roaring. Look where we've been the last 2 quarters of measurement. Well above, right? And so we might accidentally think, or the consumer might think, well, that's really good. It's not so good because it causes inflation, right? So they want to get it back to 2, and that's why they've been, they were rather ratcheting up the cost of money, which interest or mortgage rates kind of followed because they wanted to slow the economy down to curb inflation. This is GDP per state. So you can see that the US percent change was 4.9% from Q2 to Q3. And Oregon was kind of right there at the national average, 4.8%. And you could look at county data, et cetera, if you really wanted to go that deep. But I only show you this slide because I want to remind you that even though some of the numbers we're going to talk about today, a lot of them are national numbers, they help you understand how to interpret and explain this information. The local information is much more valuable to your clients. Yes or yes?
Yes.
In Albany, for example, right? Because that's where the consumer is buying or selling, and that's what they care most about. This information will help kind of set the table for some of those hyper-local conversations. So we talked about inflation, kind of here's what it looks like over the last number of years. See that we have this huge spike in inflation when that GDP went up to 33.8, for example. And here's the thing about inflation. A democratic government like ours believes that inflation is one of the biggest threats to democracy, right? For a couple of reasons. Well, one main reason, and that's because inflation doesn't actually impact everyone the same way. It doesn't impact the haves and the have-nots, if you want to think of it, the same. If you have plenty of discretionary money in your budget and the price of milk and gas and other things go up, then it may not affect you that much, even if it annoys you. But if you're scratching to get by and every penny counts and the cost of gas and milk and everything goes up, that impacts you in a much deeper way. Is that fair to say? Yes. So a government like ours says that's not a good thing, right? That's a threat to our democracy and widening the gap. And so we'll do anything we can to curb inflation. Now, the government doesn't have a lot of levers to pull. They only have a couple. And one of them is raising the cost of money. And that's exactly what they've done. And we've seen that, right? Interest rates tripled, if you will, because they're like, oh, we got to get a handle on this spiking inflation, which they have to a degree. Now, if you look at the upper left-hand corner again, 2% is the goal. Same as GDP. They want inflation to be 2%, around 2% or lower, right? So that we can protect our democracy. That's one way of thinking about it. But they've not been able yet to get it back on where they want it. Matter of fact, you can see that the CPI actually ticked up in the last measurement, and they still want it to come down closer to 2, which is why there's a lot of conversation around them, staying higher for longer in their monetary policy rather than like bringing rates back down immediately because they're looking at this data. They're like, oh my gosh, like it's working, but is it working enough? Because we still have far to go. The difference between CPI and core CPI, just so you know, you can see here is energy and food. Energy and food tends to be a little more volatile. So when we pull those two things out, it's kind of what they consider the core, but they look at both of these very closely.
And housing is a big component of that, right?
It absolutely is. Yeah, we're going to look at kind of housing and how that contributes to inflation, right? Inflation being like things costing more, right?
So even without energy and food, of course CPI is higher than the CPI in December. So that almost seems like more volatile.
Yeah, if our goal is 2%, right, and we're at almost 4%, we're still double where we need to be. So from a fiscal policy, they need to consider keeping things tighter for longer until some of these indicators of the economy start coming in line with where they want them to be, right? There's a lot of conversation out there and has been for years at different times. It kind of, there's more of a conversation around it, but if our debt, the US debt would be downgraded, which would be a real challenge to the US dollar and our economy in general. And you can see why there's conversation around it. This actually comes from NAR. But the red line there, or what Bruce called orange, or NAR called orange, looks red to me, but Albany, you know. Colorblind. But my point is that that's actually the tax receipts, how much the government's bringing in revenue, and blue is the expenses that they're spending. So if the government was a business, they're spending more money than they're making.
For how many years?
And that's a concern, right? Now, the government is different than most types of businesses in that they can just print more of it, which is also another class and another concern. But you can see where we're a little out of whack there and have been. Yes, ma'am.
I was just at the Willamette Association of Realtors meeting this morning, and John Conser is an appraiser from around here, and he told us that 40% of all money ever printed, was printed in 2020.
There you go. Right, and you can see how much was sent into the economy, which again caused an interesting marketplace to be in. Frankly, like when the pandemic started, if someone would have held a gun to my head and asked me to predict what would happen in real estate, I would not have predicted what came next. I'm sure someone would have, but I wouldn't. Right, and so there's a lot of implications to, again, printing more money. So that the question is, will our debt be downgraded? I don't know the answer. But these are economic conversations and factors we want to know. Well, why would our debt be downgraded? Maybe because we're spending more money than we bring in and we continue to print more, right? Which other businesses wouldn't have the option of doing. So here's what our debt looks like. This is the debt balance, both housing debt, which to your point is a contributing factor to inflation as well, and non-housing debt. And you can see kind of the trajectory of the amount of debt that we have as Americans. Turns out, as American consumers, we're really good at spending money, and we're not afraid to take on debt. That's all that, you know, especially non-housing debt, which is broken up even more here. Student loans, other credit card, and auto loan. And again, you can see the trajectory of the majority of this type of debt continues to go up. Look at student loan. Look at the trajectory on that. A lot of debate around the value of an education, et cetera. But yep, credit card. So we're carrying some of the highest debt levels that we ever have as a society, right? And in addition to that, we have some of the lowest levels of personal savings as a percentage of our income than we've seen in a long, long time. So this goes all the way back to 1947. And you can see that our personal savings is kind of bumping around close to the lowest we've ever seen. Right? So when we think about some of these factors in an underlying economy, you know, this is what happened when we had a pandemic and everyone was kind of scared and nervous and got free money from the government and kind of held onto it tight for a minute, but just a minute. And then they got back to doing what we do best, which is spend money as a consumer society. But this can be a concern. Our debt's higher than ever, our savings is lower than ever. These are some factors that we think about in the underlying economy. This is actually personal income growth, so wage growth, if you want to think of it that way. Percentage change by county, a little bit hard to see it, but you can see that the US percent change here at the bottom right was only 2% from 2021 to 22. So remember, if our incomes on average were going up by 2% and inflation was 6, 7, 8%, what's happening, generally speaking? The cost of everything is going up at a much higher rate than us making more money. And so affordability of different things becomes an issue. Right? Have we seen affordability be a hot topic of conversation in the real estate industry? Right? Same for the same reasons in general, right? Like appreciation and average price went up dramatically, but incomes didn't keep pace, as this demonstrates. Right? So affordability becomes a challenge, particularly with first-time home buyers and certain other demographics. So let's look at some real estate information. We just looked at a bunch of economic information because we know that sets government policy and it affects our industry. This is the total number of home sales annually all the way back to 1990. And you can see kind of where we've highlighted in pink these two similar periods of time. So back in the Great Recession, right, 06, 07, 08, you can see that total sales dropped those 3 years by 2.4 million and 2.3 million in the last 3 years. Right? So if we're feeling this in our businesses and in our marketplaces, it's because it's a pretty significant drop pretty quickly. Right? It's kind of like if we were, I was also telling Sue that my daughter, my 15-year-old daughter just got her driving permit.
I'm sorry.
All the conversations around how to do that well and safely. And so when I think about her as a driver that's learning, there's a difference between kind of gradually easing down on the brake, right? If you're coming up to someone who stopped, for example, or like standing up on the brake. And we kind of stood up on the brake. Yeah. This was not a gradual, slow down. This was like a boom, right? Did it feel like that? Right? So that's what happened. Now, what I want to point out here is there's a lot of consumers, and by the way, a lot of agents that are wondering, is this time like last time? And what I want to indicate is that in certain ways, yes, this would be one of them. In certain ways, in terms of how quickly the number of transactions fell, this time is like last time. But there's other key areas where it's not like last time. And it's really important for you and the consumer to understand where it is and where it's not, so that we can use our advantage, actually be an expert on what that means, and communicate it with confidence in such a way that gives us an advantage. Does that make sense? Because they don't understand to the degree that we should, and they're like, "Oh, this is just like last time." Might a buyer think that's not educated well? I'm gonna wait until prices come down dramatically because that's what happened last time. And might that be a bad decision?
Yeah.
Depending on their goals, right? Because there's certain ways that this time is not like last time. We're gonna look at a few of those. So here's what that looks like monthly. You can see in blue 2022, and then salmon. Is that salmon? You show 2023, something like that. So you can see that the number of home sales has just been coming down pretty dramatically. And if we look back actually on 3.8 million in 2023 was the lowest number of sales since 1995. Wow. That's a long time, right? So this is a reality that we're facing. Okay, so let's look at prices. Talk about inflation or appreciation in this period of case. But that green line, that greenish line, is the 4% long-term average. And you can see kind of where we're at today in terms of the average price nationally. We're quite a bit above that 4% average. And you can see what happened the last time that we got quite a bit above the 4% average. Now, is this time like last time? In some ways, yes. In some ways, no. But you can see where the consumer might think that. And regardless of if it's like last time, you can see where affordability becomes potentially a challenge. It's a really powerful visual graph on what happened following the last Great Recession and kind of where we're at today. Right? Now, question for you again, perspective and becoming an expert and communicating with confidence, depending on someone's goals. How many of you wish that you would have bought more investment real estate in 2006? Now, if I asked you that in 2009, would you accept the same thing? Well, maybe, depending on your perspective. But again, the reason why these things are powerful is I wish I bought every single property on the block back in 2006. Because look where they're at now. Things like this are good perspective for people that may not otherwise have it, right? We'll talk a little bit more about the power of kind of visuals like this as we go along. But this is what the pricing looks like monthly. So again, this is just annually. This is broken down into monthly back to January of 2022. You kind of see that ebb and flow of pricing, but prices have not come down. Even though units have come down dramatically, prices haven't come down dramatically. Now, this is nationally. Let me ask you, in this part of Oregon, have average prices dropped dramatically?
No.
No. Now, why do you think that is?
Inventory.
Inventory. There you go. So let's look at inventory, because this is one of those times when this time is absolutely nothing like last time
Yes.
when it comes to inventory. Remember the big dip in prices that we had here, dramatic dip in prices? Look how much inventory existed. Look how much inventory exists now. Low, 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 and has been low. Right? Is that similar to what you're experiencing here?
Yes.
Right? We haven't had what we would consider a balanced market in over a decade. 2012 would be the closest to that 6 months of supply, which we consider balanced between buyer and seller. Right? Teach that in the shift book. So what are your thoughts on inventory and why it matters to prices? Why does inventory matter so much to what's happening with price? Supply and demand. Supply and demand is the biggest driver of prices, more than interest rates, more than policy, more than anything else. If you have more buyers than sellers, then you have upward pressure on prices, right? Now, when we think about prices coming down dramatically, how many months of inventory would we need to have based on the 6 being balanced? How many months do we need before prices would start to come down dramatically? 8, 9, and we're at 3.1 months. So again, if the consumer says, "Ooh, this time's like last time, and so I'm going to wait to get a way better deal," might they be missing it altogether without an expert communicating that in such a way that helps them make a good decision? See the importance of that? See why that's a huge advantage if you're doing that well? So this is what inventory looks like on a monthly basis. We just looked at the annual, and you can see that it's actually continuing to come down. And from 2023, it continued to come down from the high, which is in October. And it's actually a little bit higher than it was same time last year. And that's December numbers, but it's still crazy low. Still nowhere near the number that would impact prices dramatically, right? Now, this could change on a very hyper-local level. Let's say that in a particular part of the county or community that you operate in, a new builder just came in and opened up a couple hundred pieces of inventory. Could that change what happened to prices in that particular area as an example, right? So it's important that we understand the local nuance of all this information. Okay, here's new construction, because that's a part of our inventory challenge. And you can see the single family housing starts. Now, there's some good news on this slide. November and December, we're actually above what we consider that 1 million starts per month. That's kind of what we're looking for in terms of, that's seasonally adjusted. That's how many new construction sites we feel like we need in order to help keep up with inventory. So being above that is good, but you can see how long we were below that. I don't know if I have, whoops, sorry, I don't have that annually, but if you look back in years, all the way back to like the early 90s, you'll see that after the last recession, we had like this lost decade where new construction was way under the million average start mark, because a whole bunch of builders went out of business entirely, and not all of them came back into business. And it took a really long time for us to get anywhere near that 1 million mark. So that's contributing to our inventory challenge. is lack of new construction. The reason I show you this slide too is that, again, on a broad scale, new construction is not going to solve our inventory problem. It can't actually. Why do you think even if they wanted to, they can't solve the problem for us?
They're not building entry level stuff.
That's part of it, right? Part of it is challenges with capital too, because the interest rates have gone up for them. We still have some lingering supply chain issues, although a lot of that's been solved. We have a labor shortage, which we saw, right? There's more red tape for building new construction than ever before. So they can't ramp up as quickly as we would want them to, even if they wanted to. Does that make sense? So they can't by and large solve our inventory challenges. By the way, what do you think from a resale perspective is contributing to our low inventory? Right? Existing homes.
Existing mortgages that are under 5%.
So we're going to look at that a little bit more specifically because I think you're right. Well, some good news there. And then, of course, mortgage rates. And so we'll get into that now. You can see, again, back to 1971, what the mortgage rates annually were, right? And so you can see if you look all the way back to 71, or actually 72 is what it shares there at the bottom, the historical average was 7.81. And if you look back to 1990, the average is just under 6. So again, this is context for somebody that only remembers what rates were 2 years ago, right? Is it fair to say that some consumers have a legitimate hangover from 2% interest rates?
Yeah.
Yeah, it's real. Right? How many of you have a mortgage on your primary residence that's under 3%? Raise your hand. Okay, less than I thought actually. And we're going to look at what that looks like. But the idea is if I wanted to buy a house a couple of years ago and I didn't pull the trigger, it wasn't quite ready yet, and I was looking at what I could afford and I was looking at 2% interest rates, and now I didn't buy, and now I'm here, I have a hangover from that. Like I have a legitimate emotion that would frustrate me around that. Is that fair? So when we share a slide like this with someone who's feeling that way legitimately, we offer perspective that they might not otherwise have. We offer a different lens to look through than maybe the one that they're currently looking through. It doesn't mean we eliminate all their frustration, but an expert says, I know that you're feeling frustrated, but let me share something with you that might help you feel just a little bit less frustrated and help you make a good decision based on your long-term goals. See the value of that? I don't want to convince you. I want to share something with you that might help you think differently and get past this hangover that you have around what rates were versus what they are. What if you bought your first home back in 1982? How do you feel about a 7% interest rate as an example, right? So this is perspective we're not. One thing that I would share about this slide, and this is a good time to point this out, is there's a real deep value in visually explaining this information like this, right? Because a huge percentage of humans, which is who we're talking about, are visual learners. I'm one of them, right? I was sharing with Kristen this morning how I've got this new digital tablet, Remarkable, but before I had like stacks of legal pads where I'm always scratching notes, writing on the whiteboard, because I'm a visual learner. It helps me remember it, retain it, understand it. So if you say something to me, I probably get it to a certain degree, but if you show me, it really sinks in. So using a graph like this when you're giving information creates a lot of validity to what you're saying, but it also helps people understand it better. So in listing presentations, in buyer presentations, in the ways that you can communicate visually, I really highly encourage you to do that. So I'm going to give you these slides and keep them updated to a degree so that you have them to use, right? This is a good example of that. Okay, so I'm not going to spend much time on this, but this is actually the spread between the 10-year treasury, which is what the government kind of controls with their fiscal policy and mortgage rates. So the government actually doesn't control mortgage rates, and a lot of consumers don't understand that. They think that when they raise the rate, they're actually raising the mortgage rate. They're not. They can't. The mortgage rates are set by the banks and lenders based on, in large part, the 10-year treasury. That makes sense? What this is illustrating is that the margin, right, the gap in between what the 10-year treasury is and what mortgage rates are is as high as it's ever been. And it's because lenders are placing a higher level of risk and what they expect in return based on the 10-year treasury, meaning that there's a lot of uncertainty what the federal government's gonna do next. So higher risk means we want a higher margin. And because rates went up so dramatically and there's a lot of prediction that they're gonna go back down, if someone gets a rate now at 7% and they go back to 5 in the next 2 years, what might that borrower do?
Right.
Refinance. So if I'm lending the money and the time horizon in which that loan can be paid off is shorter, then I might want a little bit higher margin. Does that make sense? So not too much detail on that, but this is, in conversation as well around why the spread is higher than it's really been in a really long time. Okay, so here's what mortgage rates look like monthly. You can see where we're last month as an example, under 7%, right? So we're definitely down from the high that we saw back in about October. And again, a lot of speculation on what the Fed's gonna do in March or May or June. But we saw some of the underlying economy numbers that they're looking at. And what did the economy look like? Strong or weak? Generally still strong. That's a lag measure. So all their policy is a lead measure, but they have to wait to see how that impacted the economy. And as these numbers continue to come out, we just tick up in inflation, not good. It's demonstrating underlying strong economy. So if we're going to predict what the federal government's going to do, I hate predictions because they're so wildly inaccurate, but if we listen to what Jerome Powell, the head of the Fed, is saying, he's saying higher for longer. And we're continuing to watch the numbers, and we're not going to rush into bringing it back down because he's seeing the same things we just saw. Sense? Okay. So let's look at NAR membership. NAR's certainly been in the news lately, huh? Anybody listening? By the way, if you don't pay much attention to real estate news and it would bring you value, Bruce and I have a podcast called The Real Look, and we comment on real estate news every week for about 15 minutes or so. Not a very long commentary. We talk about these things, what they mean to real estate agents. So check that out if that brings you value. But NAR has absolutely been in the news, lawsuits and all the things. And so you can see what's happening with membership nationally. By the way, most of this changes has nothing to do with the news. It has to do with agents getting out of business because things are tightened up in key ways. You saw the number of units and transactions happening. So agents are getting out of business. As a matter of fact, you can see kind of this wave. We call that the law of equilibrium. If you've not read the shift book, you need to go get it today and read it. No kidding. If you have read the shift book, you should go get it today and read it. No kidding, right? But we talk about the law of equilibrium. So as the commission dollars in the industry ebb and flow, then the number of agents in the industry ebb and flow with it, but it lags. So how long now have we been in a declining from a unit perspective market? 2 years. 2 going on 3 years. Yeah, this will be the 3rd year, to your point. And so you can see now that even during a couple of those years, membership was still up or holding, and now it's starting to dip because it lags the commission dollar. Right now, there also is a lot of maybe more questions and answers around what will happen with non-membership going forward, because as you may have seen, even Keller Williams now, based on part of our settlement, clearly states that you do not have to be a member of NAR in order to be a Keller Williams agent. Right? So we're going to see what that means to membership, but what we're seeing now is not like a huge outflux of members based on any of that. We're seeing it because they're getting out of business, right? So we'll continue to watch that. This is what it looks like. I thought I have a slide that shows NAR membership in Oregon. So I'll make sure I get that to you. I must have actually deleted it because I was deleting Washington and Idaho and Alaska, and I must have actually deleted Oregon. But Oregon's is dipped as well, I can tell you that. And that information is on the slide I can send you. Take a deep breath before you look at this slide. Really deep breath. Let's practice our breathing here. This is the number of sides available per agent, 4.89, which is the lowest it's ever been in the history of tracking this data. Why? Because, well, a whole lot of real estate agents got into the business in the last decade, and then we saw units drop dramatically in the last couple of years. And you can see that it's happened a few different ways. Back in 2000 and 2007, prices were going up, remember? And so a whole bunch of real estate agents got in the business because there was more commission dollars available, and then units dropped back then. And so sides actually went down from 13.5 to 7.5. And then when units came down, we went from 6.9 to 9.3. during those 4 years. And now it's gone back down from 9.8 to 4.9 because of agents getting in and out of the business. You can see NAR membership going up, going down, going back up. Questions or thoughts around that?
You guys are so much above that.
But yeah, that's if every single agent is selling something.
Yeah, that's right. That's the total number of agents divided by the total number of transactions. Now, the good news in this slide is this is what's happening around us, but it doesn't have to be what's happening to us. There's nobody in this room that's like, I'm trying to be the average agent, right? And no one online either. I'm certain of that. And so here's the good news. Every market I go into, every single market I go into, there are agents having their best year ever or had their best year last year ever. You do not have to participate in the average of the marketplace. You just want to understand what that means to what's happening around you, right? This doesn't have to be you based on your sphere of influence and your lead generation activity. Now, if you don't do anything differently or you don't think differently, this is the risk. See the difference? As an expert, as a professional, I know that I'm in control of my success, not this information. But if I don't do anything differently and I become a cork on the ocean of the industry, then this is my risk, right? So when we operate in reality, we actually can get into action in a different way. Does that make sense? So I want this to be encouraging to you, even if it looks dark and gloomy. This is just nationally. By the way, professionals love it when there's really good competition. And that's what this indicates, that there's more competition for every transaction than there has been before. Why did professionals not worry much about competition? Matter of fact, they welcome it. Makes you better. Makes you more focused. Sharpens the skills, right? Go get back in the classroom. We're talking today about reinvigorating engagement in our training calendars throughout the region as an example, right? Why? Because when we track the numbers, we know that agents that go to 2 or more trainings a month make dramatically more in income than those that go to less than 2. We look at like the engagement across the region that we have in some of our trainings, and I'm like, well, where is everyone? Well, we got out of the habit because we were just bumping into deals on the right, bumping into deals on the left, and we didn't think that was important anymore, but it is. And a professional knows that. So if you watch the top agents, if you pay attention to what they're doing, they're going to more training now than they have in a decade because they know the value of it and they know that's their advantage and they know that's what will keep them from participating like the average agent. Does that make sense? There are absolutely things we can do to make sure this is not us. This is what it looks like from a volume perspective. So you can see that in 2023, the average volume per agent was under 1 million available. Again, total volume versus total agent. And you can also see that ebb and flow of what that looks like. Okay, we talked about this. So here's some actual data behind what you mentioned earlier. That's part of our inventory championship. 89% of mortgages have a rate of 5% or less. And if we're at what, 6.7 last month, we're still well above that. But look at how much lower it actually is if you break that down even further. Almost a third of all mortgages are under 3%. Forget 5. And almost, what is that? 50, that's almost 2/3, not quite, under 3.5%. So does anyone feel like me that has a super low rate? They feel like they're kind of sitting on a lottery ticket. Yeah, I feel great about it, right? And I'm not saying that to rub it in. I'm saying that because unless I have a really strong incentive to sell my house, why would I? I've got like this 2.7% that I'm really, lucky to have. And I don't know that I want to trade it in for a 7% or 6.5% unless I have a real need. Does that make sense? Mm-hmm. So this is creating part of our inventory challenge. And the reason I show you this is we know 2 things. One is there's opportunity here, and I hope to illustrate that to you in a second. But number 2 is that, we may be a while from getting anywhere close to that. There's plenty of people who argue that we'll never see rates that low again. Now, I don't know if that's true or not, but those were historically low for quite a long period of time. So if I'm the buyer who's like waiting for that, or the seller who really wants or needs to sell, but I'm waiting for rates to go back down to 2.5%, what are the chances that that even happens? Right? And how's that keeping me from my ultimate or overall goal? Well, I might need an expert to explain that in a way I can understand, right? So let's look at this in a little more detail. So again, we're talking about mortgage rates. There's 87 million homeowners in the US. Each one of these little tiny houses represents a million. So you have to take my word for it, but there's 87 up there. I didn't count. But again, power of visualization. So 87 million homeowners. Did you know that 39% actually have no mortgage on their home? They own it outright. Is that surprising to you? It was to me when I first saw this. If I would have guessed the number, I wouldn't have guessed it. Almost 40% no mortgage, totally own it outright, which leaves 61% that have a mortgage. So let's break that 61% down a little farther. 31% of those have 50% or greater equity, right? They owe half of what the home's worth or less. And then 30% with 50% or less equity, which could be 49, 48, 47. In other words, there's a lot of equity right now in the homeowner universe. Why do we think that is? Demographics. Tell me more.
The age of the owners,
Sure.
just the fact that we have another generation that's retiring, biggest one, so most likely they're going to try to pay off their homes.
Yep, that's absolutely a factor. What else is a factor in all this equity that exists out there?
Appreciation, considerable appreciation. Last 5 years.
Dramatic appreciation in the last 5 years. Dramatic. Some of the years were huge. And by the way, have we lost all that appreciation because prices have come down dramatically? No. So what does this mean? It means there's a lot of equity out there. A couple different things. One is some people are asking, well, what about, is this time like last time? What about like bank repos and short sales? Like, is that going to be a thing again? The default rate right now is still under 2%. Why? Because of this. You get behind on your mortgage, but you have 50% equity in your home. Do you have options? Yeah, that wasn't the case last time, right? We had all these people that didn't have equity in their homes and they missed a couple mortgages and they were in big trouble, right? So I just thought a bunch of short sales and REOs, etc. But this time isn't like that the last time in this regard. And by the way, banks and governments and programs that offer assistance or tacking some of those months onto the end, forbearance, if you will. There's more of those options than there ever has been, in part because of what happened last time. We want to keep people in their homes if we can overall. So the chance of the default rate getting super high is very low, part because of this. So let's look for opportunity in this. We know there's lots of equity out there. This kind of summarizes it. 70% of homeowners have at least 50% equity in their homes. That's incredible. So if you're a homeowner, you're like, yeah. You're a renter, how do you feel? Did I miss it? No, right? We'll talk about that. But let me ask you a question. Is there anyone in any of your sphere of influence, is anyone that's ever considered owning a piece of investment real estate as part of their wealth building journey, a rental or something like that? Mm-hmm. Yeah, every single one of you, guaranteed. Now, if you can't think of anyone off the top of your head, then I'm going to encourage you to be in closer conversation with your share of influence because they are in there. Now, by the way, some of them might be dreaming about that 10 years from now. Some of them might be dreaming about that 3 years from now. Some of them might be ready to take some equity and buy a rental property today because they own their home outright or they have 50% equity and they're not sure how to unlock that in such a way that helps them build wealth. Is that our job? Yeah. They don't understand it quite like we should. It means we get to guide those people at the appropriate time for them, but they exist, right? That's a huge opportunity. So, for example, remember the who, what, why, where, when, and how. If I were to, say, post something on social media, for example, that had a picture of this slide, and it said something to the effect of, hey, everybody, I'm getting a lot of questions from, my friends and family around how they leverage equity in their home to build more wealth. For example, owning rental properties. If that's something you've ever considered, reach out to me. I'd love to buy you a cup of coffee, walk you through your options, talk about why that might be a great option, but understand your situation a little more. That would be a long post, but something like that, right? Am I creating conversations with the people that I want to serve? Am I using a visual and information that they don't actually know exists, but they know how much equity they have, I bet. Maybe they don't, right? So all of a sudden, I'm using this to my advantage with the people I want to serve most. Does anyone in your sphere of influence have a dream of one day owning a second home or vacation property? Place on the lake, place in the woods? Yeah, in all of your sphere of influence, there's at least one and probably more. Same opportunity for the right home. By the way, if you're dreaming about that 5 years from now, do I want to know? That? Heck yeah. Because that deal in 5 years is as important to me as the deal if someone's like, actually, I can buy a second home now. I didn't realize that. How can you help me do that? 100%. One's not more valuable than the other. They're both valuable, but I want to be in those conversations. Does that make sense? Yeah. That's my advantage. Okay, it's your advantage. All right, so let's look at some more local data, and I'm going to go through this kind of quickly for a couple of reasons. One, we're going to run out of time. Two, you're going to have all these slides. And three, you have better access even to this local information than I ever would. But this is an encouragement to understand this. So what you'll see here is the median price in these counties. Red is what's for sale. Blue is under contract, and green is what's sold. January of 2022 to January of 2024. I know it's really hard to see because it's tiny. But you can see that the average, or rather median, not average, median price has gone up in all three of those categories in the last couple of years. Not surprising, we saw that in the national data, right? Now this is going to break, this is supply and demand, so this is inventory. And you can see that actually the amount of inventory for sale has actually gone up slightly, not dramatically, and we actually saw that in national numbers too, right? But the under contracts and solds have gone down, right? That dip in number of transactions happening. So inventory's gone up a tiny bit, but still low, and number of transactions have gone down, right? So we're gonna break this out by different MLSs and then different counties. So I'm just gonna kind of scroll through these because then it's by each county rather than combined. Glenn, Benton. But here's a slide that I really wanted you to see. This is from the NAR too, right? Again, perspective for people. If we look at the net worth, that's what this is comparing. The net worth of renters in blue versus homeowners in pink. You can see what it was in 2019. So again, we think of owning a home as a great piece of building wealth in America, right? And you can see the difference in average net worth. But you can see how it changed in a very short period of time, 3 years. The average net worth of a renter went up by about $3,000. The average net worth of a homeowner in that same period of time went up by more than $100,000. Right? Because of the run up in appreciation and the value of owning a home. So if people are like, gosh, I missed out, go back and show them the slide that has the annual price. Remember we talked about buying more homes in 2006? Mm-hmm. If you were looking at this in 2006, you might think that you missed out in 2003 or 2002. But over the course of time, you didn't. Make sense? So this is important to remind those people that are on the fence or wondering if they should wait. It depends, right? So one thing I'll say about being an expert is it comes with a lot of responsibility, right? The job of a professional, the job of an expert is not to convince anyone to do anything. It's to give them information and interpret that information in such a way that helps them make good decisions and accomplish their goals. Make sense? So it depends on the person. Everyone has a different need, a different time horizon, a different level of income, different needs. So understanding that and then interpreting it in a way that's helpful to them is the job of an expert. Not convincing them that they should do something. That's really not a job. Matter of fact, Gary Keller says the definition of leadership is to teach people how to think so that they can do the things they need to do when they need to do them so they can get what they want. Teaching people how to think, right? That's what we're working toward here as an expert. This is good news as well. So this is encouragement as we kind of wrap up. When you think about the real reasons that people buy and sell real estate, these are them, and this is how much of it's going to happen over the next 2 years based on data. Bruce calls it the 4 Ds, the real reasons people buy and sell real estate. We got debt, death, divorce, the job. Right? So that's Bruce's joke. If you thought it was funny, I want to make sure he gets credit. didn't think it was funny. I want to make sure it gets credit. But I was actually sharing some of this information in Sun Valley back in the fall at a market center there. And there was an agent in the group. He said, "Hey, Chase, there's a fifth D." And there's probably more than five too. But he said, "I said, what's the fifth?" He said, "De Niro." And I was like, "Oh yeah, you're right." Right? Like having cash or having an abundance of or equity like we saw is another reason that people transact, regardless of what interest rates are. Right? If I'm paying cash for a property, do I care what the interest rate is? No. Right? So I bet if we were to look at all the transactions that closed in this market center in January, I'm willing to bet a good portion of my nest egg that almost all of them are related to one of those five Ds.
Oh, yes.
This or an abundance of cash. Right? Oh yeah, they were moving because of a job. They were moving because of death. They were moving because of divorce. They bought a house because they wanted to buy a rental property and had cash to do it. But if we broke it down like that, that's the case. That's the good news. In other words, no matter what's happening in the market, this is going to happen. It's going to cause people to move and transact. The other thing is there's still more than enough transactions happening in your market. There's more than enough for you to accomplish your goals. Every single month, every single year, you don't have to participate in these averages just like we talked about. So hopefully that's encouraging to you, right? Okay, big ahas. When you think through what we just covered and hopefully the lens with which we looked at it, what were some of your ahas or takeaways that you can leverage in your business?
Not making those comparisons to the last recession and knowing the difference that people can make the choice.
Because the risk of not communicating that well, number one, we lose our advantage, and that's what we're talking about. How to do more business, well, we need to take advantage, right? Number two is the default to us not communicating well is what they see or hear in the news, or what they hear from Uncle Sal at the Thanksgiving table. He's never sold real estate, but he seems like he's an expert, or he thinks he's an expert. Right? That's a fictional character, by the way. Give him Uncle Sal, no offense. I don't either. But my point is that it's not the news's job to educate. Like literally, it's not their job. Their job is to get eyeballs on their stories. And they're really good at that. So they have these crazy headlines. And you read the story like, wow, clickbait. We've heard all these things, right? That's actually their job, not to educate. Our job is to educate. That's where our advantage is. So if we leave our consumers out there listening to the real estate news without us, that's not a good thing, right? And we have the resources and tools to do a way better job of that, because that's our advantage. That's a great one. What else? A couple more ahas. Yeah, it's good.
Value of business.
That's right. Yes.
Yeah, good reminder. I try to never get too far away from the whiteboard because I'm so visual, but a really large percentage of everyone else is too. Yes.
I would say a good reminder constantly is that with all the doom and gloom, no matter what training we're going to include yours, is that has nothing to do with what we're doing in our businesses. So let every other realtor at any other company be like, oh my gosh, there's less sales, let's go get a different job. Like to keep, that has nothing to do with us. It's good to know. It's good to be aware of what might be considered reality, but it has nothing to do with our businesses personally.
That's right. Understanding it to interpret it to help our consumers accomplish their goals is what the value of it is, but it doesn't have to impact our business. It's our job to understand it, interpret it, not participate in it.
Yeah, right.
Right? Love that aha. By the way, what's the opposite of an expert?
Ignorant.
Amateur?
Yeah.
Yeah, so what percentage of realtors, none in this room, none in this market center, I'm sure, but what percentage of realtors are operating like amateurs right now?
Oh, a lot.
Not going to classes, not learning the information, not knowing how to interpret it,
Chase. They've done it for 20 years.
right?
Yeah.
They've sold the same one house over and over again for 20 years.
Yeah.
So, right?
Right, but you could be 6 months in the business and be an expert. And
That's right.
outsell, show, and speak to this much information over somebody who's been in business 20 years to stop.
100%. And well, here's my question, right? To put myself on the spot. Will you walk away today after this information, feeling at least a little bit more like an expert and at least a little more confident in how to understand and interpret it for your clients?
Yeah.
Because if not, I did a poor job. If so, all you did was just increase your advantage to whatever degree over those that are still sitting at home in their PJs. No offense. I'm not pointing to you. I'm pointing
Like,
so, I'm just joking, but I'm not joking in that it's like how we show up and how we participate will determine the size of the advantage that we get. And when the competition's never been greater, then that advantage becomes more important and more pronounced, to your point. Gosh, how are you winning when the market's so bad? Well, because I'm not participating in that. I'm just understanding it so I can have an advantage.
Yeah. Can I piggyback on my aunt? It also showed me that I need to stop waiting to be asked and I need to start going to tell. So I show up as the expert.
Yes.
That's what you, like this presentation, I was like, oh my gosh, I need to stop waiting to be asked to market and I need to go tell.
Proactive.
Yeah.
Yeah, think of it. There's a good example of this that happens, and the buyers tell us this when we survey the buyers every year. National Association of Realtors does this for us, right? Is the buyer wants us to bring properties to them that might be a good fit. They actually see that as professionalism and part of our value. They don't want to have to email us and say, hey, I saw this one came on the market. Should we go look at that one? But some realtors, those that are not acting like experts, have gotten to this habit of like, well, they haven't seen anything that they like yet, I guess. So I'll just wait until they call me to go show property. It's like, no, they actually expect me to be like, hey, did you see this one? Should we go look at that on Saturday? Same example here. They don't want to have to ask, like, what does all this information mean to me? They want you to understand their goals and say, hey, can I show you something I think would be valuable for you to understand? Right? That's what a professional does. They're proactive. And that creates an advantage, right?
Well, and I think there's an opportunity, like you mentioned clickbait, right? You know, the doom and gloom, the bad news. So I think there's an opportunity as agents in the social media and in their message to create their own form of clickbait anti the culture and use these little stuff. What if it wasn't? You know, what's the opposite of that, right? And get attraction and attract engagement for leads, you know, by throwing out some of these pieces of information that are valid, and yet consumers are just aware. You know, asking the question, you know, and posing the information so they can think about it.
Totally. Well, and so it's a different way of thinking about the opportunity that's right in front of us, right? Matter of fact, as a realtor, my job literally is to meet with people and interpret what's happening based on their goals. That's literally my job. It's not to transact. That's the result of me doing my job, which is saying, hey, there's a lot of information out there about what's happening in the industry, and most of it's confusing. If you want clarity on what it means for your goals, give me a call and we'll schedule a time to meet. I'd be happy to do that for you. Do I sound like an expert?
Yeah.
Do I sound confident?
Yeah.
Am I doing my job? Mm-hmm. Will that probably lead to the result of my job, which is more transactions?
Yeah.
Right? Mm-hmm. Like if we're not meeting with people and talking about this stuff, what are we doing? What are we doing? Right? Like, well, we're operating like amateurs. No one in this room, no one online here. But you see where this is a massive opportunity, and it'll be to the 10th degree in this type of market. But helpful?
Mm-hmm.
Great. Well, thank you guys.
You continue to reinforce the responsibility that we have to mitigate current climate fears, implications, and perspectives, and break it down, you know, give them confidence in data.
Yeah, thank you. I think so too. And by the way, like, if you really want to get good at this stuff, number one, communicate more often on purpose, proactively, teach it.
Yeah.
Right? Come and teach it. We're going to update this data pretty much every month now. For a while there, we weren't getting it as often as we wanted regionally from KWRI. No offense to them, right? They just don't have the resources, but so now we're updating it. You'll see some of these data points are like a couple months behind. That's because it comes out a couple months behind.
Yeah.
But Marissa and Crystal and the team are going to be updating these slides every month. So you guys will always have them. They say teaching is the highest form of mastery.
Yeah.
right? So like, whatever you got from today, I got more because I get to practice demonstrating my expertise. You can do that locally. You can do that at your association. You can do that here. For the agents, you can practice and teach this stuff in such a way that like, it's so obvious that you're the economic local economist of choice that you create an advantage to the 20th degree in those, right? So just encouragement, right? Like, don't come and learn this stuff and you're like, oh, that was great. I feel a little more confident than I didn't do anything differently, right? Get the slides, use them in the presentation. Chances are you're probably not going to print off this whole deck and put it in like a plastic sleeve because it's probably should be like that thick. However, if you have these at your fingertips, then you'll be able to access them when it's like, oh my gosh, one of my clients said something. I'm like, oh, I remember that slide. Oh, that's a great question. Let me show you. Right? Expert, confidence, advantage. Thank you guys again. I really enjoyed being here. And if there's ever anything I can do for you, please understand that part of my whole region is support and serve you. Don't hesitate to reach out to me directly through the leadership, et cetera. It's been great meeting you. So,
Thank you.
Thank you.
And Jill's
just like
up to date every week.
now, just let's cancel it.